In this video, we're going to go over a few methods on how investors can supercharge their dividend investing journey and show you how to do it step by step. Dividend investing in my eyes might be the truest form of passive income, and this is because you can make a one-time investment and receive dividend payments for the rest of your life potentially. And because of this dividend income you receive, this could be the key to your retirement, or possibly even being able to retire early, or simply even having the ability to work part-time and enjoy your life doing whatever you want, like spending time with family and friends. Now we are going to go over multiple different methods in this video, which will offer different pros and cons, so make sure to stick around until the end of the video and comment down below which method you align with most. So first off, in order to know how much money you need to earn from dividend income on a yearly, monthly, quarterly basis, you are going to need to know one important metric. You are going to need to know your actual cost of living. Now your cost of living is basically how much money you spend or your family spends on a consistent basis. And according to Google, the average cost of living in the US is estimated to be between $2,500 and $3,500 per month, depending on location, lifestyle, and this includes things like housing, food, transportation, healthcare, and other things. So of course, cost of living is going to depend on where you live, if you live in an apartment, in a house, if you have a family, etc., etc. But this is a very important piece of the pie. So you're going to need to figure out this number if you actually want to retire off dividends. So although obviously cost of living is going to vary quite a bit, for the sake of this video, let's use the number $3,500 per month as a cost of living expense and see how much of different stocks or ETFs we would need to purchase in order to have their dividends completely pay for our living expenses. Now, like I said towards the beginning of this video, different options, different methods are going to have different pros and cons. Take option number one, for example, investing into the SCHD ETF or the Schwab US Dividend Equity ETF. Now, this option is going to have a lower initial starting dividend yield compared to some of the other options we're going to go through. So that means that you're in theory going to need to have much more money invested into something like SCHD in order to retire off the dividends today. But that being said, SCHD does offer things like potential ETF price appreciation, which means your net worth could go up substantially while holding on and getting paid along the way. Now, some more highlights about this ETF: a straightforward, low-cost fund offering potential tax efficiency. The fund can serve as part of the core or complement in a diversified portfolio. Tracks an index focused on quality and sustainable dividends, and invests in stocks selected for fundamental strength relative to its peers based on financial ratios. Now, on top of that, SCHD offers massive dividend growth, which means that over time, if history was to repeat itself, you are going to get paid more and more and more as the years go on. Now, because SCHD pays around 65 cents per share on a quarterly basis, let's just say 22 cents per share per month on average. So if we were to take 3,500 and divide it by 22 cents, we would need around 15,909 shares of SCHD in order to completely retire off the dividend. Now, SCHD is currently $69.42 per share, which means we would need to have around $1.1 million invested into SCHD in order to do so. Now, the next ETF is going to have some better things to offer than SCHD potentially, but also some cons to go along with it. So if you were to invest in, for example, the JP Morgan Equity Premium Income ETF or JEPI, and you wanted to get to that $3,500 per month on average to allow your dividends to completely cover all your bills and more. Now, looking at JEPI, for example, on the max time frame, you can see that JEPI looks much different than that of SCHD, for example. JEPI most likely is not going to grow and is most likely not going to really raise your net worth over time. On top of that, because of the income-oriented strategy that the JP Morgan Premium Income ETF offers, this ETF is not necessarily going to pay you more and more in dividends as the years go on either. But it's not necessarily all bad. JEPI pays around 34 cents per share per month, at least that's what it's paid as of recently. So if we divide 3,500 divided by 34 cents, which is how much each share of JEPI pays per month, we would need 10,294 shares of JEPI. Now, JEPI is currently trading around $52.40, which means an investor would in theory only need $539,411 in order to completely retire off the dividends from JEPI. Now, another interesting option could be to invest into the Simplified Volatility Premium ETF. Now, heading over to the Simplify ETF's website, it says Simplified Volatility Premium ETF seeks to provide investment results before fees and expenses that correspond to approximately 1/5 to 3/10 the inverse of the performance of the VIX index. Now, SVOL actually shorts the VIX, the volatility index, and by doing so, it generates a lot of income, or at least it has, on a consistent monthly basis. Now, even though SVOL has a much higher dividend yield than that of JEPI and SCHD combined, as you can see here on the max time frame, it has had some ETF price decay, which sort of seems to be the case for a lot of these higher yielding ETFs. So that means in simple that if you were to invest in $100,000 when this ETF began, you would only have around $89,000 as of right now, although you would have of course got paid some massive dividends. And the dividends are definitely massive. SVOL pays around 30 cents per share per month. So if we were to divide $3,500 divided by 30 cents, we would need to purchase around 11,666 shares of SVOL in order to completely retire off the dividend. Now, because SVOL is around $22 per share, an investor in theory would only need to invest around $256,000, which is way cheaper than that of both of the examples of SEHD and also of JEPI. Now, the final last example that we're going to go through on how an investor could retire as fast as possible off dividends is going to be investing into something like the TSLY, the Yield Max Tesla Option Income Strategy ETF. TSLY is a Yield Max Tesla Option Income Strategy ETF. It pays a dividend monthly and uses a cover call strategy to do so. Now, this is another option strategy ETF that I'm sure you've heard of, and as you can see, just like the other higher yield options, it's currently down quite a bit in the max time frame, which seems to be the model here. But even with that all being said, TSLY has a 53.12% dividend yield and paid 58 cents per share last month. So if we were to take $3,500 and divide it by 58 cents per share, we would need to purchase around 6,034 shares of TSLY in order to reach that $3,500 goal every single month in theory, if nothing were to change, of course, which it likely will. But still, with TSLY only being $13.60, that means an investor would only have to purchase, in theory, $82,000 worth of TSLY in order to have their entire $3,500 a month budget satisfied with completely living off the dividends. Now, some important takeaways is that we went over some extreme examples in this video. We looked at things like TSLY, and we even looked at much more conservative, slow and steady investments like the SEHD ETF. And what's pretty cool about the stock market when it comes to building out a strategy and a plan for you personally, there's so many different options out there and they all have different ways to get you to where you want to be. Now, for me personally, as a more long-term dividend growth focused investor, I like to invest the majority of my portfolio into safe names similar to that of SEHD that might offer a decent starting yield of around 3, 4, maybe 5%. But more importantly, I don't really want to have most of my portfolio decaying in share price over time. Because after all, even though a lot of these covered call ETFs do offer massive potential monthly income, I personally don't want to be invested too heavily into something that's going to be decaying at this rate. Now, the problem with most ETFs or stocks that have an initial higher starting yield is that they do come along with some risks. Things like price decay or even dividend cuts could definitely in theory make the higher initial yield not really even worth investing into at all. But now it's your turn. I want to hear from you down below. When it comes to building a plan to live off of dividends as fast as possible or as safe as possible, comment down below which of the ETFs you would pick. If you could only choose one, would it be the SEHD ETF, the JEPI ETF? Would it be SVOL or TSLY? Comment the name down below. If you enjoyed this video, make sure to please drop a like in it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.